Howdy, Jacob here. Today we are looking at Genmab in the biotech industry with 19.2 billion market cap, just 15.1 billion enterprise value. Looks like they develop antibody therapeutics for treatment of cancer and other diseases, primarily in Denmark. Founded in 1999, so it hasn't been around that much for that long, but it's still a $20 billion business. That's cool. Revenue growth, pretty substantial, very substantial, over 10 times, 141 million in 2014 to 2.4 billion in 2023. Margin perspective, gross margin is nearly 100%, operating margin above 30%, return on invested capital averaging in the low 20s, very good. Balance sheet, this is insane. So 2.1 cash on hand, 2 billion short-term investments, and only 530 million in total liabilities. So that's why their enterprise value is so much lower than their market cap, which is a very positive sign. And then when it comes to free cash flow, darn if they're not just reinvesting, buying back a little bit of shares, paying down a little bit of that debt. I mean, great use of cash. Again, I don't know when they're buying back these shares, so I can't guarantee that this is a great use of cash. But based on what you can do with free cash flow, obviously, I don't have the allocation for what I would have done, but buying back shares, hopefully very cheap, and then reinvesting back in yourself at a 20% rate of return, historically, pretty good, pretty solid bet on yourself. And so I would say that, I'm ready to make some assumptions here. I think from a numbers perspective, looks fantastic. Now let's get to valuation. Growth, well, I think it's slowed down a little bit. I would presume so. I mean, they are an $18 billion company but they do only make 2.4 billion. Here's what I'm saying, only 2.4 billion. Yeah, crazy. Maybe they grow at, I don't know, 10% a year with a 20p in price free cash flow at the end of 7 years. Margins have gone down from 5 years ago pretty heavily, so maybe I do pretty close to an average here. Maybe let's do 36, 32, no share change. They did buy back some shares, so yeah, that is their stock-based compensation. That's pretty heavy. So let's assume flat on the share change, and they're just using their money to reinvest back into themselves to get this 10% revenue change per year. I mean, 36% off, not terribly far off. Again, I've said that it looks farther off than what in reality it is, because most companies' variance is about well over 30% in a year. And so I think that, it wouldn't be surprising if this were to fall within these initial buy price estimates before I do a deeper dive. But for now, just a bit too much for me. I'd want it to fall a little more before doing more research to be more comfortable with these assumptions. So hopefully you enjoy the video and have a great rest of your day. Thank you.